Today I'm going to share my top 5 rules that every person thinking about house hacking should know. These are legal rules and also some rules that we've implemented into each of our house hacks from experience so far. So rule number 1, residency requirement. One of the most important rules of house hacking is that if you purchase your house hacks with a loan, which is almost always the case, you must live in those properties for at least 12 months before you can get a new owner-occupied or primary residence loan in your name. So if you are house hacking every single year, this is extremely important. But the good news, don't have to worry too much, hopefully, because your lender will see those loans and the dates that they were issued. And you might not know this, but mortgages are public knowledge, which if you're a homeowner, you'll understand this, is the reason why you start to get a bunch of spam or junk mail pretty much as soon as you close on your home and you move in. And this mail is like junk mail from insurance companies, home insurance, and creditors and all that stuff. So your lender has this info as well and should be able to tell you the earliest date that a loan can be issued in your name or when the earliest closing date can be on your next house hack. Of course, hopefully your lender does their digging properly too, but you should always track it on your own just in case. Attempting to get a new loan without following this 12-month residency requirement could potentially result in mortgage fraud, which is a serious felony charge. To keep that 12-month timer going in the back of your head, because you can't house hack if you're in an orange jumpsuit sitting in the clink. Which leads me to the next rule. This is extremely obvious, so I'm not going to go too deep into it, but it has happened before and likely why this is an actual rule when it comes to purchasing a house with a loan. Believe it or not, you actually have to live in the property you purchase with owner-occupied financing. If you don't, this will also be a call into the feds for mortgage fraud. Okay, moving away from the legal stuff here for a minute. Next rule, is understanding tax deductions and rental income. This is pretty important, so I wanted to clarify this a little bit because I was way wrong and thought this was different before we started house hacking. At the time of recording this video, and at least how it's been since we started back in 2020, is while you're living in your house hack property, you can deduct mortgage insurance, mortgage interest, and closing costs to the full amount for the portion of the property that you live in or occupy. But those deductions for renovations, maintenance, repairs, and other expenses related to the portion of the property that's being rented only apply when you move out and that property becomes a full-time rental. And this is where it gets a little tricky and where we got it wrong. If you're renting out units or renting out bedrooms within your property while you are still living in that property, tax deductions can only be made for the portion of the property that's being rented out. For example, if you're house hacking a duplex and living in one side while you're renting out the other side, deductions for maintenance, repairs, the other stuff that I mentioned are still deductions, but rather than being able to deduct it from the full amount or to the full amount, you can only deduct 50% of it because you occupy the other 50% of that property. It really gets tricky if you're renting out bedrooms in, say, a single family home or a townhome, because a lot of the space that you're using is shared with other people. So consult with your CPA or a tax professional on how to approach this. Just leave it to the pros. Don't try and swindle something here on your own just so you can save a couple bucks on a tax deduction. This brings me to our next rule. Document everything and keep your receipts. And I'm not gonna lie to you here, this is another thing that we screwed up on. Not keeping any receipts of the things that we've done to that place when it came time to file for taxes. If you remember from previous videos, I mentioned we replaced floors, carpet in that first house hack, plus some of those other value add features. Well, when it came to filing for taxes, I figured just showing a bank statement of the payment from the company that did the work would be just fine. Well, I didn't get deductions on those because I lost the receipts. I don't remember how it played out, but I had either not filed for a tax filing extension soon enough, or if it was something else, but I couldn't get the receipt in time for when we had to file. Moral of the story here, keep your receipts. However you want to keep those or store those. Efficiency and ease, always the goal when it comes to house hacking. Learn from my mistakes. But continuing on, talked about this a few weeks back in the video talking about how to put your credit cards to work. While credit cards and financial tracking tools can help organize your spending, also help put those into categories, receipts are the proof of what was actually done and also what that expense was for. Don't put yourself in the same scenario that I was in, not holding those receipts. Now our last rule here, and if you've been following along with these videos, this should be rule number 1, but treat your house hacks like a business. It's a huge mindset shift for sure by trying to change from this is where I live to that change to this is now an income source or an investment. Rather than thinking of every little thing you have to fix or repair as an expense, consider each of those as an investment in your business, which it is. Now, don't just go out and start fixing things up that aren't broken just to get a deduction. This is where treating these places like a business returns the favor as we wrap this up here. You call up your CPA or your tax professional towards the end of the year, and you might be looking at, let's say, $1,000 you have to pay in taxes on one particular house hack or property that you have. Your tax pro might say, instead of paying the government $1,000 in taxes, is there anything that you need to do to the property that would maybe total around $1,000 that you could just deduct instead? So you find something that needs fixed for $1,000, whatever it is, call it a washer and a dryer, that your tenants have been complaining all about. And all of a sudden, that $1,000 that you would have paid in taxes to the government instead went towards an improvement or repair towards your house hack. That's the power and the difference of treating your house hacks like a business, because it is. You're running a small business. Balance sheet stuff with income and deductions, all of that stuff is great, but it means nothing. It means zero if you don't have your mindset right, your tenants are having bad experiences, or God forbid, your house hacks aren't even renting out, solely based on the fact that you don't have your in order. I don't know how to bleep things out for editing, but don't be that guy or gal. Just do it the right way. Threw a lot at you here. Not trying to talk anybody out of house hacking, because it is the absolute best way to build wealth and purchase investment properties. But just that small mindset shift on your house hacks are extremely important. It's not scary or an unsurmountable feat to tackle once it's done right. Follow these rules, be prepared, get it all in order, and you'll maximize the full potential or opportunity here that house hacking is bringing to you and your personal wealth building goals. So that about wraps it up. Thank you guys so much for watching. If you found any value in this video, please like and subscribe. Post these twice a week on everything house hacking. So thank you again, and we'll see you guys next time.